Broadcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon. Thank you all so much for joining us today for our June webinar on Social Security. And for those of you joining us for the first time, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth Capital Management. And I've been with the firm now for about 4.5 years. My primary role includes client service, marketing, and compliance. I would just like to start off with a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled For Questions. Please feel free to submit your questions throughout the course of the webinar, and I will go ahead and monitor all of your questions and will ask David to answer as many as time allows at the end. But if we do run low on time and we are unable to get to your question, David or I will reach out to you directly after the webinar to make sure that we do get your question answered. Now I would like to introduce our speaker for today. David joined our firm back in 2016 as a senior financial advisor, bringing with him over 20 years of experience in financial planning and wealth management. And prior to joining us, David most recently spent 10 years at Commonwealth Financial Network, assisting over 1,500 advisors nationwide with complex financial planning solutions and building comprehensive wealth management plans for clients. He continues to bring his expertise to our firm by conducting portfolio reviews with all of our clients, co-managing client portfolios, and building, analyzing, and maintaining comprehensive financial plans. David also serves as a member on our firm's investment committee. David, thank you so much for joining us.
Thank you very much, and thanks for everyone who is able to join us today for our webinar. It's a very important topic. We at Stonehearth often get asked by our clients about Social Security benefits. They're an important part of everyone's retirement income picture, and for many people, especially those without a pension, which we still see some pensions out there, but we see less and less of them. So for many people, these benefits represent really the only guaranteed retirement income source that many retirees will have for the remainder of their life. So these benefits are important, and the rules around these benefits are quite complex. And they're ever changing. So we really feel that this is something that's an important focus for many people to have a good handle on. And additionally, we also want to stress that it's important to look at these types of benefits in concert with the rest of one's financial plan, and not just isolating Social Security benefits just as on their own, which there's plenty of tools out there where you can analyze when I claim my benefit and how much it will be. But it's also important then to take those numbers and bring those into your overall financial plan and see what makes sense with the rest of your assets and maybe some other income streams that you have. And then, of course, for married couples that may be both qualifying for benefits and both have assets or income streams from other sources, it's even more important to look at these benefits and see how they all work in concert with each other. So we're going to spend time today talking about some basic rules around these benefits and how you qualify for them, and also talk about different claiming strategies as far as when you claim benefits and how much your benefit may be reduced if you claim early and how much your benefit might be added to if you claim later than what's called your full retirement age. So let's jump right into it and start talking about the rules, starting with how you qualify for benefits. So in order to qualify for these benefits as a retired worker, you must earn at least 40 credits over your lifetime from a job in which you paid into the Social Security system. So to qualify as work, you must have earned reported income and paid Social Security taxes on it. And for 2019, you have to earn just $1,360 in covered earnings to get one Social Security credit. And
David,
you can earn up to, yes.
Sorry to interrupt you. We do have somebody on the webinar who's unable to hear us. So I just wanted to ask if you can hear us, if you can just type in the chat that you can, in fact, hear us. We're just trying to figure out if this is a, GoToMeeting wide. Oh, she can now hear us, actually. So I'm sorry to interrupt. You can go ahead and continue.
Okay.
Thanks, David.
Okay, yeah, sure. Thank you, Amanda. So when you can qualify for benefits, you're earning these credits throughout the year. So you need 40 work credits are needed, and you can earn up to 4 credits per year. And the way that you earn those credits is based on the amount of earnings that you have in a year in which you're working at a job that you're paying Social Security taxes. So for 2019, you have to earn $1,360 in earnings to get 1 Social Security credit. And you can earn credits throughout the year, or you can earn enough money in 1 quarter, which would be $5,440 to earn the maximum of 4 credits for the year. So since you can only earn 4 credits a year and you need 40 credits to qualify for a benefit, you need at least 10 years of work in which you're paying into this system in order to qualify for a benefit on your own record. So those don't have to be consecutive years. You can have periods of time when you weren't working, or you may work in a job in which you were paying into the Social Security system, and then maybe you stopped and became a teacher or had another job where you weren't paying into the system. But as long as you earn those 40 credits over a minimum of 10 years, then you're eligible for a benefit. So that really is the starting point to say, okay, am I eligible to receive a benefit? Now, the second part of it is calculating your benefit. So the dollar amount of your Social Security benefit is based on your lifetime earnings. And your actual earnings are adjusted, or what they call indexed, to account for changes in average wages since the year the earnings were received. So basically to account for inflation. So the size of your benefit in retirement that you're going to get from the system, it really depends on how much you earn during your working life. And the administration keeps a record of how much you made every year, and they base that benefit off of your earnings, but the amount of earnings that they're going to base the benefit on is capped. So, for instance, in 2019, your wages up to a limit of $132,900 are going to be considered for your calculation of your benefit. So any amount of earnings you earn above that don't factor into the calculation of your benefit. So that's called the Social Security wage base. And for 2019, it's $132,900. That's up from the 2018 number last year, which was $128,400. So if you're earning around that wage base every year, you're considered what's called a maximum wage base earner. So you're going to be getting the highest amount of earnings that's going to go into the calculation of your benefit. And what they do is they calculate your average index earnings, and they use 35 years in which you've earned money, and they apply the formula to those earnings to arrive at your basic benefit or your primary insurance amount. So you'll hear that term a lot when you read or hear anything about what your benefit's going to be. So they always use 35 years to calculate what your primary insurance amount will be. So let's say you're someone that, for whatever reason, only worked 30 years and paid into the system during those 30 years, then they're actually going to put 5 years of zeros into your calculation to get to the 35 years. So they always use 35 years. Now, what if you work 40 years? Well, they'll take the 35 highest earning years to calculate that. And sometimes we'll get the question of, well, I'm thinking about going into semi-retirement where I might work part-time, but I don't want to hurt my Social Security benefit because I'll be earning less. So the real answer is, well, you may or you may not. So they're always going to take the 35 highest years. So if you go down to part-time work in the semi-retirement mode, that part-time work might still be a higher amount than earnings that you made 35 years ago. And don't always go by the dollar amount, because the amount that you earned 35 years ago, they're going to adjust that for inflation and make it similar to today's earnings. So, you know, it can get fairly complicated when you look at that. So you don't always want to just say that part-time work you do in retirement may or may not help you. We mostly find that in most cases it actually does help you, because even part-time work that you have later in your career is going to be worth more to the calculation than years of earnings you had in the very early part of your working career. Now, when you claim will really matter how much your benefit will be. And there's this whole notion of what your full retirement age is. So you can see in that second column on this chart, the full retirement age is noted. And for those that were born between 1943 and 1954, the full retirement age went up from 65 to 66. And you can see for that small group of folks who are born in the 5 years of 1955 to 1959, your full retirement age increases by 2 months for each one of those years that you're born between 55 and 59. And then those who were born in 1960 or later are going to have a full retirement age of 67. And if you move over to the right one column, we're showing the benefit amount at age 62, which is the earliest that you can claim a benefit. So we're basing all of this on if your full retirement age benefit was $1,000 per month, your benefit at those ages where you claim early at 62 are going to be impacted by that. So taking the top row there, if your full retirement age is 66 and you claim at 62, you'd be claiming 4 years earlier, and your percentage of reduction is 25%. So instead of $1,000 a month, you'd earn $750 a month as a benefit. Now you can see how that percentage reduction increases as your full retirement age increases. So for those with a full retirement age of 67, if they claim at 62, which is the earliest you can get a benefit, now they've claimed 5 years earlier, so you're going to have a 30% reduction in benefits. So it's always important to really see whether or not that makes sense. So if you have a reduction in benefit, it's important to remember that that's going to be a reduction for life. Your benefit just starts at that smaller amount, and it may get increased annually for inflation, but you're kind of permanently reduced, so to speak, from what your full retirement age benefit will be. But there's certainly cases where that could make sense. Maybe you've retired early and you need to start that income stream to make life work, and you don't necessarily want to start pulling from your portfolio early. Maybe you're a single person and you have average to below average life expectancy because of a certain health condition, then maybe it does make sense to start claiming early and start your benefit early. So we find that typically the break-even point between claiming at 62 or 66 is going to be about 11 years out from your full retirement age. So you see somewhere around your late 70s is when you're going to break even, and you'd be better off having waited to claim the higher benefit if you think you're going to live, beyond that break-even point. So again, important to look at all that within the framework of your entire financial plan. So when you claim also matters. So we talked about this age 62, that's the earliest eligibility for claiming a benefit. And we looked at how your benefit could be reduced by 25 to 30%. Now it's a permanent reduction, as I mentioned, so that's something to be aware of. And the next I guess, pivot point would be looking at one's full retirement age. That's when you're receiving 100% of your primary insurance amount. And we talked about the way that the full retirement age increases based on your year of birth. There's been some talk about the full retirement age maybe increasing again up from 67 as a way to repair the Social Security funding system, but we haven't seen anything finalized on that yet. But it's been one idea proposed as a way to fix the Social Security trust fund that's there to pay out the benefits. And then, of course, you have your ability to delay claiming a benefit beyond your full retirement age. And this is when you're getting into receiving what's called delayed retirement credits. And for every year you wait to claim your benefit after your full retirement age, your benefit's going to increase by 8% a year, and it's going to max out at age 70. So for those with a full retirement age of 66, If they wait till age 70, that's 4 years that they delayed, 8% a year. Their benefit's going to be 32% higher at age 70 than it was at age 66 in that instance. So let's examine exactly what that's going to look like. So here we see each blue bar represents a different age that a person can claim, and at the top of the blue bar you've got a monthly Social Security benefit amount. So we're assuming in this example that the full retirement age is 66. So right in the middle there, that's the full retirement age of 66, and you're going to get $1,000 a month. So we already talked about how a person claiming at 62 is going to be reduced 25% down to $750 a month. And I just mentioned a moment ago, the person who waits till 70 is now going to get 32% increase in their benefits. So you're going to go all the way up to $1,320 per month as a benefit. So it's a really nice guaranteed increase that you're going to get for those 4 years after your full retirement age. So it could be worth it to wait and do that. But what I really like to highlight on a slide and a exhibit like this is look at the difference between the age 62 and 70 benefits. So it can be a really big difference. Now it's 8 years that you're going to delay and wait to claim a benefit, but for some people that might be worth it, particularly in a married couple where the higher wage earner, if they're the person that can delay receiving their benefit, the higher benefit amount getting increased by 8% a year is going to be a higher dollar amount increase. And really for a married couple, if that higher wage earner can wait and get a larger benefit, that's really going to be a benefit for both lifetimes of the couple, because while the worker is alive, they're going to get that benefit. And if they were the higher earner, when they pass away, the surviving spouse is going to continue to get that same benefit. So that can really be a lifetime benefit that person can receive. But that difference between age 62 and 70 is a pretty big benefit. In fact, that age 70 benefit is 76% higher than the age 62 benefit. So it can really pay to wait longer. Now, I talked about a moment ago about that benefit being available for both spouses' lifetimes. Now, there's certainly a lot of situations where both spouses qualify for their own benefit, or maybe just one of the two spouses worked and the other spouse that didn't work and pay into the system is eligible to receive what's called a spousal benefit. So in order to be eligible for the spousal benefit, you have to be 62 or older, and the working spouse whose record this is based off of must be currently collecting their own benefit. And the spouse must be legally married to the worker that has claimed their benefit at the time of the application for the spousal benefit piece. And you have to be married for at least 1 year prior to applying for the benefit. Now, note that if you were born prior to January 2nd, 1954, and you've already reached your full retirement age, you can choose to receive only the spouse's benefit and delay receiving your own retirement benefit until a later date. But if your birthday is January 2nd of 1954 or later, the option to take only one benefit at full retirement age is no longer there because of the change of the rules. So now if you file for one benefit, you're automatically going to be effectively filing for all retirement or spousal benefits. So I'm going to cover this in more detail in a few minutes when I go over the newer rules that went into effect a couple of years ago. So we'll come back to that piece. But continuing on now with the spousal benefit. So how much are you going to receive? Well, when claiming benefits as a spouse at their own full retirement age benefit, now this is the spouse's age at which they claim the spousal benefit. So if they wait till their own full retirement age, they're going to get 50% of the monthly benefit of the worker's spouse if they receive the benefit starting at the spouse's full retirement age. So just as we saw a reduction in the primary worker when they claim their benefit early, there's also a formula that reduces the spousal benefit if the spouse claims early. So if the spouse's full retirement age is 66 and they start receiving benefits at age 62, they won't get 50% of the other spouse's benefit. They'll get 35%. Now, what if they wait till age 65 to claim the spousal benefit? That's just 1 year earlier than their full retirement age, so they're actually going to get just under 46% of the worker's benefit instead of 50. So one important thing to note, though, this is a unique situation where you can, as a spouse, actually be getting more than 50% of the worker's benefit. So let's say even if your spouse claimed early and is receiving a reduced benefit, but you can still get 50% of their full retirement age benefit by claiming the spousal benefit at your own full retirement age. So let's just isolate that for a moment and look at an example. Let's say we're using the numbers that a worker can get $1,000 a month at age 66, but they claim their own benefit at 62 and they're getting $750. Well, let's say their spouse is 4 years older and they're already 66 and they want to claim the spousal benefit. Well, the spouse, because they're their own full retirement age, if they claim the spousal benefit, they're going to get 50% of that worker's $1,000 benefit. So they would get $500, even though the worker claimed early and was getting $750. So there are situations where you could get greater than a 50% benefit as a spouse. Now, looking at another type of benefit based off of a worker's record, it's the ex-spouse's benefit. And to be eligible for that, you had to have been married to the worker for at least 10 years, and you are not remarried, and you have to be age 62 or older, and your ex-spouse has to be entitled to Social Security benefits, and your own Social Security benefit is less than the benefit you would receive as an ex-spouse. So the benefit as a divorced spouse is equal to a maximum of 50% of the ex-spouse's full retirement age if it's collected at your own full retirement age. So just like the spousal benefit. But if it's claimed prior to full retirement age, the divorced spouse benefit is reduced in the same manner as what we saw the married spousal benefit discussed a moment ago. But here's an important distinction for the ex-spousal benefit as compared to the married spousal benefit. So the current spouse must be receiving the benefit, but an ex-spouse does not have to be receiving the benefit for their ex-spouse to claim that spousal benefit. So the idea is for a divorced couple, that primary worker only has to be eligible to receive a benefit, in other words, age 62 or older, but that worker does not have to actually have claimed their benefit for their ex-spouse to be able to get the ex-spousal benefit. So that's an important distinction. Now, as I mentioned, with the ex-spouse, you have to have been married for 10 years. So it's actually possible in some circumstances where someone can have multiple ex-spouses where they were married for at least 10 years. And if you have multiple ex-spouses where you can qualify for a benefit, then you can only collect one of those benefits. You're just going to get the higher of the ex-spousal benefit that you're qualified for. You can't stack up multiple ex-spousal benefits. It would be nice if you could, but they don't allow for that. Now, another benefit would be a survivor benefit. So we've got the spousal benefit, the ex-spousal benefit, and now we're looking at the survivor benefit. This is a benefit based off of a primary worker's benefit, but someone who has passed away. The surviving spouse can receive the survivor benefit as early as age 60 or age 50 if you're disabled. But remember now, we said normally you can claim the benefit off your own record at 62. But as a survivor benefit, you can start that at age 60. It's going to equal 100% of the deceased worker's benefit when the survivor claims at full retirement age. Now, remember, if a reduced benefit was being paid to the individual who passed away, then the survivor benefit is going to be based on that amount. Now, just as we saw with the spousal and ex-spousal benefit, a partial benefit is paid from age 60 up to the full retirement age, depending on when you claim. So if you claim as early as possible at age 60, you're going to be getting about 71% of what the deceased worker was receiving when they passed away. So you want to be aware that just like the other benefits, there's a penalty or a reduction of benefit if you claim prior to your full retirement age. I think by now you've seen that this full retirement age is sort of the magic number to get to, where you eliminate a lot of these penalties and bring some other claiming features into play. Continuing with the survivor benefit here, you have to be married 9 months prior to the worker's death in order to qualify. And you can collect your own or the survivor benefit, but not both at once. And if the surviving spouse had been receiving their own benefit, that benefit would drop off if it was the smaller amount. Now, if the surviving spouse was already receiving their own benefit and the benefit was higher than what their decedent spouse was getting, then they're just going to stick with their own benefit. So you're just going to get whichever benefit is higher. But an important thing to note here is that the survivor benefit can be claimed independently of one's own benefit. So they're actually considered two separate benefits. So one strategy might be to claim the survivor benefit at maybe a younger age, or do that first, and then allow your own benefit to get those delayed retirement credits of 8% per year that I talked about. So you can claim the survivor benefit for a period of time, and then at a later date, switch over to your own benefit that has now been increased. So the survivor benefit does not get the delayed retirement credits. You're only going to get up to 100% of what the worker was receiving when they died. But your own benefit, if you let that sit and increase, your own benefit can be getting the delayed retirement credits in the meantime while you're claiming the survivor benefit. So you don't impact your own benefit by claiming the survivor benefit, even if you claim the survivor benefit prior to your full retirement age. Now, I mentioned previously that the surviving spouse can begin collecting the survivor benefit at age 60. However, they can collect the survivor benefit at any age if there happens to be children in the family under the age of 16. So in situations where someone unfortunately might have passed away at a younger age, there may be children in the household younger than 16, and even if that spouse was younger than age 60, they're going to be able to collect benefits based on how many children in the household are under age 16. And also, unmarried children younger than 18 will also receive a survivor benefit, and that will stop when the individual reaches 18. So in both of these cases, the surviving spouse and any eligible children would receive 75% of the decedent's benefit, and it's subject to some family maximums. So if you're in that situation, you want to be aware of working with the Social Security office to see what the family maximums are, so you can't get above a certain amount. Now, if you remarry before you reach age 60, you cannot receive the benefits as a surviving spouse while you're remarried. But if you wait and are remarried after you reach age 60, you will continue to qualify for benefits on your deceased spouse's record. However, if your current spouse is a Social Security beneficiary, you may want to apply for spouse's benefits on their record, because if that amount is more than your widow or widower's benefit, you receive a combination of benefit that equals the higher amount. So you just want to be aware of what those amounts are, and as I said, you'll get the higher of the two benefits, but you won't get a combination of them. So let's spend a couple of minutes here talking about some different Social Security claiming strategies. And it's important to note these because some of the newer rules that have been put into place, and they've been around for a couple of years now, but I still think it's worth mentioning because there are some people who are still grandfathered into the old rules. There are one of the rules that is going to take a while to sort of ripple through the amount of time you can do it based on one's date of birth. So I want to highlight these rules here and make sure that we clear up the way these rules work, because these were very important claiming strategies that a lot of people tried to take advantage of, and advisors would work into key financial planning decisions with their clients. And I think really the reason why these rules aren't around anymore and aren't as beneficial as they were is because the administration saw that these rules were so beneficial, and maybe there were some unintended benefits to these rules that really made it, gave people the ability to claim a lot more in benefits than the rules otherwise intended. So as a result, oftentimes when something is too good to be true, then the law will change on that. And on November 2nd of 2015, the Bipartisan Budget Act of 2015 became law. So the new regulations significantly changed the Social Security planning landscape for millions of retirees. And the changes mainly affected two strategies that helped retirees really increase their total lifetime benefits. So together, these two strategies, known as file and suspend and the restricted application, allowed retirees to claim income now and then claim even more later. So that kind of went against the initial spirit of the way this whole Social Security retirement income was envisioned back when it came into play many decades ago. So this Bipartisan Budget Act was meant to address some of those issues and try to help keep the system solvent for benefits for future generations. So let's first look at the file and suspend rules. File and suspend refers to a method of claiming benefits which allows someone who has reached full retirement age, currently 66, to file for their own benefit, then immediately suspend those benefits. And the primary purpose of doing this under the old rules was to trigger the availability of the spousal benefit by starting their own benefit. But by suspending their own benefit, it meant that they would now receive those 8% a year delayed retirement credits. So the idea is someone turns 66, they file for their benefit, but they immediately suspend it. But by filing, it triggered the availability of the spousal benefit, because the spousal benefit isn't available until one files. So someone raises their hand and says, oh, I want my benefit, but hey, I'd like to suspend it. And the win-win is that while it's suspended, your own benefit gets the increases each year, but then anyone else in your family that could claim a benefit off of you, mainly a spouse, they can say, hey, my spouse claimed. It doesn't matter that they suspended, they claim. Now I can go ahead and get the spousal benefit. So the Act provided that window of time in 2016 to be able to take advantage of the old rules, but after April 29th of 2016, if a person suspends their benefit, then any benefits tied to that record, like spousal or child, will also be suspended. So it really took away the main planning advantage of doing the whole file and suspend in the first place, because if you file and then immediately suspend, no one else can claim a benefit off your record. So it really became not that great of a feature to even file and suspend in the first place. So another feature of file and suspend that was impacted was the ability to request a lump sum. So anyone who executed a file and suspend after April 29th of 2016, they're no longer able to request a lump sum of benefits while they have it suspended. And the way that works is, let's say that you reached age 66 and you filed and you wanted to suspend, but then you change your mind at age 68 and say, well, I'd like to turn my benefit back on. Well, it's 2 years later, so your benefit could be 16% higher, Or you could say, you know what, just pay me 2 years worth of benefits while I was suspended. Pay me those 2 years of benefits in one lump sum. And then they would view that as if you claimed at 66 because they paid you those 2 years of benefits as a lump sum. So that lump sum option is no longer available. So all of these things happened a little over 3 years ago. So why are we even bothering mentioning that now? Well, there actually is, going forward, there really is only one reason to file and suspend. So it's not as if file and suspend went away. Many people say that the new rule took away that option to file and suspend. You can actually still do it. It's just that many people don't because the spouse can't claim their benefit anymore. But going forward, there's really only one reason to file and suspend, and that's to really increase your own benefit if you had claimed early. So for instance, if someone claimed their benefit at age 62, and thereby they were receiving only 75% of their full retirement age benefit, they can still file and suspend when they reach their full retirement age. Then by suspending their benefit, they would stop receiving a monthly benefit, but the benefit would begin to accrue those delayed retirement credits, and for every year they wait, 8% is added to your benefit. So if they delayed to age 70, their benefit would have increased by 32%, which when added to their reduced benefit, that would get them to 99% of their full retirement age benefit. So the delayed retirement credits only go to age 70, as we talked about. So for practical purposes, there's really no benefit to delay claiming. So someone might claim at 62 and then say, geez, I really wish I didn't claim early because I realize how much the penalty is impacting me. So then at 66, they delay or they suspend their benefit. So if they turn them back on at 70, they're actually going to get themselves back to 99% of what their full retirement age benefit would be. So you're still able to file and suspend, but it's a fairly limited scenario in which someone would do that. So now let's talk about the restricted application. That's another method of claiming that has been impacted by those the new legislation that actually went into effect in 2016. So unlike the file and suspend, which will still be available but has really lost its initial appeal with the new rules, the restricted application will eventually be completely phased out. So filing a restricted application allows a person who has reached their full retirement age to only claim a spousal benefit. And the intent is to let their own benefit grow. So note that for this to be available, the person's spouse must already be receiving their own benefit. So the primary reason to file a restricted application at full retirement age has been to collect the spousal benefit only while letting your own benefit grow at 8% a year. It was really a way to collect the spousal benefit that otherwise would have gone uncollected if two spouses only collect their own benefit. And you're taking the spousal benefit off the table. It might be lower than your own benefit, but you can say, hey, look, I'll take a little bit of money from a spousal benefit for a few years while I let my own benefit get a bump up of 8% every year. So the administration looked at that and said, that's not really what we intended to do with these benefits. We don't want you to just collect a spousal benefit when you worked your whole career and you have your own benefit. We really put the spousal benefit in there for people who only worked a little bit or didn't work at all, so that they can share in some of the workers' career and their earnings. So they looked at that and said, this restricted application is not really a good idea. So under the new rules, it provides the ability to file a restricted application, but only to those who were born prior to January 2nd, 1954. Or in other words, people who turned 62 in 2015, which actually includes a date of birth of January 1st of 1954. They just add that extra day in there to make it a little more confusing for all of us. So since you have to be full retirement age in order to file a restricted application, and people who qualify based on their date of birth are grandfathered into be permitted to do this, the rule will be in effect for those people really until January 1st of 2020, when the youngest people in the grandfathered group reach their full retirement age of 66. So I've talked about that restricted application being phased out. So we're coming closer to when that's going to be phased out. So we'll still see that in effect until January 1st of 2020. That's when that youngest group can get to that point where they reach their full retirement age, and they can raise their hand and say, yep, I'm part of the grandfather group. I'd like to file a restricted application. So after people born after that date of January 2nd, 1954 or later, they're just never going to be able to file that restricted application. So that's eventually going to go away, and it's going to go away completely. There'll be no version of a restricted application anymore that you can take advantage of. So just kind of remember, after talking about these rule changes, that people who have already filed and suspended or filed claims for a restricted application, spousal benefits, they're grandfathered in and they will not be affected. But anyone that tries to do these things after those new rules, they're just not going to be able to do it. So remember that these took some of the teeth away from some of these nice planning scenarios that were available to us as planners when we discussed how to maximize benefits for couples, but it still doesn't take away completely the need to look at two spouses' benefits when we look at how to maximize your overall benefits. So still important to plan around these benefits, even though these widely publicized nice claiming strategies have been impacted by the new rules. Now, we often get the question, because there's a lot of confusion around this, well, what if I am working while I collect benefits? So a situation where someone's old enough to claim Social Security benefit, but they've decided to keep working. So if you're under your full retirement age, the rule is that they're going to have $1 of benefits withheld for every $2 you earn above the threshold. So in 2019, that earnings threshold is $17,640. So, for example, let's say you are 62 years old and you are receiving Social Security benefits, assuming you work and you earn $27,640 in 2019, which is exactly $10,000 over the earnings limit. So therefore, $5,000 will be deducted from your benefit. So it's a $1 deduction for every $2 over the limit. So we were $10,000 over the limit. They reduce $5,000 from your benefit. Now let's also assume that your Social Security benefit is $1,000 a month. Well, they don't reduce a little bit of your benefit each month. What they do is they withhold the first 5 months of your benefit until they've withheld $5,000. Then they will resume your full benefit payments for the remaining months of the year. So the rule changes now for the year that you reach full retirement age. In the year you reach full retirement age, for the months of the year before you reach that age, your birthday, you can earn up to $46,920 without having your benefits reduced at all. If you earn more than that prior to your full retirement age, then $1 of your Social Security benefit is deducted for every $3 you earn above $46,920. Now, once you reach full retirement age, so the actual date in the year that you reach your full retirement age, the earnings cap does not apply, and you can earn any amount without having your benefits reduced. So if you reach full retirement age in August, you can earn up to $46,920 from January through July without any reduction in benefits. And then once you reach full retirement age, it's really the month you reach your full retirement age. So in this case, in August and beyond, there's no threshold. So you can earn any amount after that with no reduction in benefits. So important to have a good handle on how that works, because it may still be worthwhile to work while you're receiving benefits, or it may not be if your benefits are going to be withheld. Now, notice I'm using the word withheld, so you don't lose your benefits. So note that the benefits withheld prior to full retirement age due to exceeding those earnings caps are not lost forever. When you reach your full retirement age, your benefits are then going to be recalculated, and the percentage that your benefit is being reduced by is lowered. So to illustrate how this works, let's assume you claim your Social Security benefit at age 62, and you continue to work, and you have had benefits withheld due to exceeding the earnings limits, which change a little bit each year. Then when you reach your full retirement age, they're gonna look at the total benefits that have been withheld, and if you've had the equivalent of, say, 12 months of benefits withheld, the administration's going to recalculate your benefit as if you first claimed at 63 rather than 62. So the net result is that your penalty for claiming early is reduced and your benefit will increase. So I'm using kind of a simple example there, but I'm saying that let's say they ended up withholding about a year's worth of benefit. Well, they're going to reduce your penalty for claiming early by about 1 year. So you end up kind of, essentially some people look at it as, well, they're paying you those benefits back that were withheld because you worked and earned over a certain amount. And that's essentially true, but I'm giving you the way the actual formula will work so you understand that. So, but the idea is that any benefits we withheld for that rule are eventually going to come back to you. I also want to talk about a couple of provisions in the rules that are going to impact the benefit you receive if you're someone who was entitled to receive a public pension. So let's look at a couple of the rules that affect people who do have public pensions but are also eligible to collect a benefit either based off of your own working record or that of a spouse. The first is the windfall elimination provision, or the WEP, and that applies in situations where a person qualifies for a public pension from a job where they did not pay into the Social Security system, but they also qualify for a Social Security benefit from other work that they may have done in their career. So if the provision applies, it only impacts a person's own retirement benefit. It does not impact the spousal or survivor benefit. And although this windfall elimination provision can reduce the amount of your Social Security benefit, it cannot eliminate it entirely. So in 2019, the maximum reduction imposed by the WEP is $463 per month. And additionally, the reduction of the Social Security benefit is limited to 50% of the public pension. So therefore, if someone was receiving a government pension of $600 a month, their Social Security benefit would only be reduced by $300 per month. So the windfall elimination provision rules are fairly complex, and there's a phase out for individuals who have had substantial earnings that were covered by Social Security taxes if you worked between 20 or 30 years. So let's say you had a career of 30 years where you did pay into Social Security and you also were getting a public pension. So by working at least 30 years where you were paying into the Social Security system, then you're now phased out by being impacted by the windfall elimination provision, and your Social Security benefit would not be impacted at all. But any less than 30 years where you paid into Social Security taxes at a job, you are going to be impacted by this rule. So it can be fairly complex. So if you're impacted by the rule, you want to just work with someone who can understand the way this provision works and understand how your benefit will be impacted. Now, the next one is the government pension offset, and this is a situation where if you're covered by a pension and you did not pay into the Social Security system at all, but rather just only the civil retirement system. So by not paying into Social Security at all, you wouldn't be eligible for your own benefit, but you could possibly be eligible for a spousal benefit. And Social Security will offset the benefits as a result of you having a civil pension. So they're going to reduce any spousal or survivor benefits by 2/3 of your civil service pension. So you would receive the full civil service pension and any additional spousal benefits if they exceed 2/3 of your pension. So just looking at how this would work as an example. For example, in the instance above, the wife would receive $1,500 from her pension, and she would only get an additional $200 as a spousal benefit, because we're saying that the primary worker is getting $2,400 a month. So the spouse could get half of that, which is $1,200, but because 2/3 of their pension is $1,000 gets reduced from the spousal benefit, so now they're only going to get $200 as a benefit. Now, what if their primary worker, their spouse, passes away? Instead of getting the full survivor benefit, they're going to get $1,000 reduced from that. So the key takeaway is any benefit you're going to get as a spouse or a surviving spouse, it's going to be reduced by 2/3 of your own civil service pension that you're getting. Just a couple of words about the Social Security statement. One thing is, when you look at the projections of the benefits that you're going to get, those benefit estimates are based on your statement. Assume that you continue to work until you begin collecting. So if you're age 60 and you're looking at your statement saying, oh, at age 62, I'm going to get this, at age 66, I'm going to get this, and at age 70, I'm going to, it's assuming that you're going to continue working at least till age 62 to get those benefits. And it doesn't assume any salary increases. It assumes that you're going to, it assumes that you're going to work until your full retirement age, and that's what those benefits are calculated on. So just remember, when you're looking at those statements, that they do build in some assumptions, and they really can't provide your actual benefit amount until you actually apply for benefits, and the final benefit determination really considers your complete earnings history. One of the things that you can do is go on to the Social Security website, and you can click on a link that says My Social Security, and you can take a couple minutes to develop your own profile within there. You end up getting a username and a password, and when you do that, they're going to have an actual record of your earnings history built right in there, and you'll be able to see the actual, 35 years or less if you're younger and you haven't worked that far yet, but then you're going to see your actual Social Security earnings right there in the system up to the wage base that I talked about. A couple more items of note about the statement. So each year they're going to review the records for all people who are working, and if your earnings for that prior year are higher than one of the years that they were using to compute your retirement benefit, then they're actually going to recalculate your benefit amount. And so you know, as you get further in your career and you might be earning more, they're going to constantly be recalculating your amount, and you may be getting an increased benefit based on that. As we wrap up here, I want to talk about some planning considerations for Social Security benefits. So even with the new rules that I talked about, it doesn't mean couples shouldn't coordinate their claiming strategies to maximize their benefits. So, you know, in fact, making the most of your benefits is more important than ever. And couples will still have still be able to benefit from a range of different claiming strategies, even with the new rules. And when you consider all of the options, one spouse claiming early, one delaying, they both claim at their full retirement age, you see that there's really hundreds of possible outcomes to consider. So it's really important to most of the time view all these scenarios in a software system. Ideally, that's looking at your entire financial plan, not just your benefits, and really consider what your best options are. And really, no strategy is right for everyone. As with most things in life, the details really matter. So factors like age and differences between you and your spouse's age, your taxes and life expectancy can all affect the overall outcome and any recommended claiming strategy for these benefits. So, as we wrap up here, I really want you to understand that the key takeaway here to choosing the right Social Security claiming strategy is to plan carefully and look holistically at your entire financial picture. And I think with careful planning, a strategy that can be developed to improve your potential total lifetime benefits that you get from Social Security by structuring the benefits to begin at optimal times can really be based on looking at your entire financial plan. So I'd like to end it there and just leave a little bit of time and see if there's any questions from the group.
Hi, David. Thank you so much. So just as a reminder, you can go ahead and use the questions section on your GoToMeeting taskbar to submit your questions over to us, and we'll get as many of those answered as we can. But I do have a couple to start with. David, how much do I pay into Social Security?
Oh, yeah. So that's referring to Social Security taxes that one pays while they're working. So right now that's set at 6.2%. So every employee pays 6.2% into the system, and then your employer also pays 6.2%. If you happen to be someone who's self-employed, guess what? You're going to pay the combination of those two because you're the employee and the employer. So self-employed, you're going to pay 12.4%. Into the system. But yeah, that's a good question. I didn't cover that in the presentation. That's also one thing that's being looked at as another way to potentially bolster the Social Security Trust Fund is maybe increase the taxes that are paid into the system. But we haven't seen anything final on that yet.
David, just expanding on taxes, the next question is, do I owe taxes on Social Security?
Yeah, that's an important question, especially looking at when you're claiming your benefits and what other income that you might have. So there's a little bit more detail around this than what I'll get into here. But essentially, for people who are married filing jointly, if your income is less than $32,000, you won't pay any taxes on your Social Security benefits. But if your income is between $32,000 and $44,000, 50% of your Social Security benefit is going to be subject to your tax rate. And if you earn above $44,000, then 85% of your Social Security benefit will be subject to whatever your tax rate is. But that's something important to be aware of as you're looking at how your benefits play into your overall retirement income needs.
The next question I have is, if you earn after FRA, do they take out Social Security?
Yes, that's a great question. So anytime that you're working and paying those Social Security taxes, they do keep withdrawing those taxes. So if you're older than your full retirement age, you're going to keep paying that 6.2% into the system. And what you can potentially be doing in that situation is actually increasing your benefit. So they're going to look at the fact that you're paying more into the system. They'll look at your wages at that point and recalculate your benefit, and they'll increase it if the recalculation warrants an increase to your benefit.
And David, I just think we do have a couple more, but we will reach out to you individually just in respect for everyone's time, since it has been an hour. So thank you, David, for all this information on Social Security. Next month, for July, it'll actually be the first week of August. We'll be doing CIO's Corner with our Chief Investment Officer, Chris Gauthier. So if you'd like to join us for that, we'd love to have you. You can take a look at our webinar calendar at our website, www.stonehearthcapital.com, and feel free to sign up for any of the ones that we have remaining, and we've got, half the year left. So we hope to have you guys on here again soon. And David, thank you so much again. Hope everyone has a great day.
Thank you. So long, everyone.